It's probably true in a lot of the world, but we're known for consumption with credit cards. And in fact, the chart on the left shows the amount of credit card debt outstanding. It's up 40% in the past 3 years. So people are running, the income growth is slowing down, and the amount of excess savings is falling. So now people are turning to credit card. Problem is, this time around, they're doing it on interest rates that are outrageously high.
Right.
21.5% is the average rate now, and that's the average. If you have a weaker credit score, you're getting up towards 30%, which really is, let me just say, it's remarkable. It's hard to justify. I understand, believe me, from being in finance and insurance and risk, I get it, that if they're going to take the risk with that low of credit score, you have to be offset by high interest rates, but that's getting super high. And we can see from this chart that credit card rates have gone up 7% since the Fed started raising rates. The Fed only went up 5.25%. Credit cards went up 7%. And again, this is a case where they're not going to come back down real quickly. But you can see the very direct effects here of the Fed raising interest rates. So you get the effect of the first two charts, increasing credit card debt at very high interest rates. You get an increase in credit card delinquencies, which is the chart over on the right, gone from 1.5% back 3 years ago up to 3.2% now, double in 2 years.
More people leaning on credit cards, and also congruent with that would be more delinquencies.
Correct. Now, these delinquencies are not at record highs, but they're sure going the wrong way. And it raises the question of how much are you going to be able to rely on credit card debt, especially when it's at 21%. So the point all this is, you can see the Federal Reserve has very clearly raised rates, which is going to crimp the consumer again. Going backwards, we have income drying up and excess savings drying up, relying on credit cards. How much longer can you do that? And that's really what the past few charts show there. Now, I'm going to go back. I think that's the last chart I have. Yeah. I'm going to go back and just give a recap here. So I say across, the inflation's not dead, so the Fed's not going to cut rates. And here's the black line, which is inflation. It's down towards 2.8% by this measure. But 2.8% is not the 2% target. So it's gotten to be a real fight. 2.8% hasn't the target, and even 2% doesn't mean just touching 2%. It means being below or at 2% convincingly for the foreseeable future. We're a long way from there.
How long are we from there?
Well, I imagine, if you're the Federal Reserve, it's going to be at least December before you feel comfortable enough to say, I think we're still headed there. And I say it's a fight because we go and look at the chart on the right. It's the same black line, only over a shorter time period. Over the past 5 months, it's only fallen 0.1%. That's the fight we have there. It's not moving. And the same thing. Go ahead.
So with that being the case, we know it's in the threes, bouncing around the low to mid threes, right?
Yeah.
Okay.
High eights, high twos, 2.8%.
Is that where inflation is right now?
By this measure.
By that measure.
I actually started off, skipped this first page. I actually started off with this, which was the consumer price index.
Right.
And it is, as you know, 3.3%.
Okay.
And it shows even that it's even more stubborn, not going anywhere for 12 months. So again, the Fed's saying, I'm not nowhere near my 2%.
How do we go from 2.8 to around 2 by December? What's going to change that's going to get us there?
Well, there is, again, a lag in interest rates. So the last few interest rate hikes, which came last year, haven't had their full effect. That is going to be part of it.
3 to 5 quarters.
Yeah, maybe as much as 6, and in some cases it's been more than that. So
Okay.
it's a matter of time. It's also a matter of there are a couple of other measures of the Fed funds rate which show that maybe it's not as restrictive yet as it should be. And what I mean is, for instance, if you look at the Fed funds rate after inflation, what we call the real Fed funds rate, it's not quite as high as it's been in similar periods to trigger a slowdown,
Okay.
to trigger a slowdown in inflation. So it needs to be a little bit higher, which will happen as inflation falls.
Mhm.
Very close to being there, but not quite there by that measure. So as inflation continues to wane away, the real Fed funds rate will get bigger and more restrictive. So time involved, greater restriction with the real Fed funds rate. And there are, a few other reasons. One might be is that we'll get perhaps a slowdown in the flow of spending out of Washington. That's kind of hopeful, but that's one of the things that's made life difficult for the Fed. They've raised interest rates so rapidly, but inflation's putting up a fight. How can this be? Well, the Fed's trying to slow the economy. Congress is trying to speed the economy up by spending all this money through the so-called Inflation Reduction Act. That's really hard to say with a straight face. Inflation Reduction Act throws more money in the economy. In any event, maybe spending will slow down a little bit, plus that time, plus a small decrease in inflation will make the Fed funds rate more restrictive.
Okay.
So I think that's the thinking, but it's also why the Fed is saying, I'm not seeing it yet. I'm not ready to cut rates at 2.8%. Yeah, it's going down, but it's like John Mahle said, it's not going down nearly fast enough.
So
Yeah,
it's
you're
difficult.
very exposed to interest rates again, construction and manufacturing,
Correct.
very interest rate sensitive, and no wonder things have gone south. I mean, the rates have gone way up.
Right. Transportation, as you know, is not normally secured debt. So,
Right.
You're not going to get anywhere near what you probably would need if someone goes out of business.
Mm-hmm. Mm-hmm.
But that's our industry.
Yeah. So inflation is not going down. The Federal Reserve's on hold. And really, the chart on the right is almost the most important thing. It just shows the cumulative effect of inflation and how prices still feel high. And this is why the administration is facing the Americans' point of view is that this economy is no good. Okay, inflation is the job market's very strong. The economy is growing, although not great, but everybody has a job. You might think that this is a really good economy. It's not if you have this kind of inflation. So
Right.
this is the problem that the administration.
Well, and it's an election year, and then we've got turmoil all over the world geopolitically.
Yeah.
So there's just so many things that I think push the negative narrative. It's all at once.
Yeah, it is indeed. So let me just page through here real quick to kind of give a recap. So we see inflation's going nowhere and is still making people suffer. But we don't think the Fed's going to cut until the end of the year. And the question is, will it matter? Yes, it matters because it affects all these other interest rates. That Fed funds rate is that single rate that the Federal Reserve controls. And once it does, there's still a lag between when it cuts rates, and it has effects on other parts of the economy. This 30-year mortgage is a really good example. Here's a point where the Fed cut rates very rapidly, but the 30-year mortgage didn't go anywhere. A lag here, a lag in manufacturing, and an effect that the Fed has on interest rates, that dark blue line, and bankruptcies. So we see that it's going to matter. It's going to matter. And in the meantime, interest rates are affecting consumers as well. Income's falling off. Excess savings is falling off. Consumers want to keep spending, which is 70% of the economy. Now they're moving to credit cards, but it's at very high interest rates. Credit card rates have gone up 7% since the Fed raised rates by 5.25%. So there we have another effect. And it raises the question of how much longer can consumers continue to do this? Probably a while, but it's not a sustainable path.
Correct. I would say most people are hanging in there and they know it's not sustainable and they're looking for it to be over.
In one sense or another.
Correct. So, Dan, we really appreciate you coming on. We appreciate the value you bring all of us and our viewers. Next time we talk, we'll be going into probably Labor Day. Next time that we have you on will be around that point in time. So, look forward to hearing what you see changes, but the changes you see between now and then. Any predictions for us?
No predictions.
No. Absolutely not.
In a sense, that's actually my business. And I suspect that, the continued big news that affects our economy and affects the financial markets and the stock market, which makes people either feel wealthy or poor, credit card rate, which drives consumption. All that appears to be hinging on inflation and the Federal Reserve, and that's why it's a big story that's talked about again and again. And my suspicion, if this is going to go anywhere, is the Fed is going to keep pushing back that date where it says we're going to cut rates.
Okay.
The previous meeting, to the most recent meeting, they came out and said, yeah, we're going to do one cut this year. The previous meeting, which was 3 months before that, it said, we're going to cut 3 times this year. Now we're down to 1. That's a big difference. Obviously, they're saying inflation's not moving. We're not going anywhere. So that's the big story, is when they are going to move.
Wow. Thanks for everything. We appreciate having you on. I mean that. It's nice to get your perspective because you're not buried in the ground floor of our industry, but you see so much of it from many different perspectives, right? So we're appreciative. We're thankful. We very much appreciate Allianz sharing you with us and the support that they give all of us and all of the shippers and carriers and companies that need that trade credit insurance. We appreciate that. So until next time, Dan, stay in your lane.
Thank you, John. Thanks very much for having me.
Continue watching on the next episode of the Stay in Your Lane podcast.